And I guarantee you, if you start implementing all these tips right after you click off from this video, that you'll boost your credit score in no time. Okay, so in this video, you're going to want to take out a pen and paper because the tips that I'm going to show you today in this video, if applied, can dramatically increase your credit score almost immediately. Well, maybe not that fast, but maybe 30 days kind of fast. Disclaimer. Anything ranging from how often you should apply for a new credit card to how much credit you should use, as well as all of the factors that go into your credit score and ultimately get those seemingly impossible to get credit cards that you see people flashing, like the Amex Platinum. Here is not me from a previous video flashing my own Platinum card. So firstly, we have to bring this down to the most basic level, which is what exactly are credit scores? Credit scores are essentially the only thing about you that the banks actually care about. They don't care about your race, your gender, your religion, or even if you have 3 legs. A credit score to them shows how likely a person is to pay back their loan or not. And naturally, a high credit score signals to the banks that this person worked hard at paying their credit off on time every month, and therefore are trustworthy with money. But with a very low credit score, the banks usually don't feel as safe loaning you money, as your credit score implies that maybe it's a little bit hard for you to actually pay back your debts, whether that be for a car or a home, and of course, credit cards. And credit scores traditionally have a range between 4 tiers. So the first tier, or the lowest tier, that's anyone who has a credit score between 300 and 629. 300 being the absolute lowest credit score that you could possibly get. With this tier, it usually means that you're either really new to credit, or you've had credit before, but you weren't necessarily responsible for it. For example, missed or late payments. With this level, you unfortunately will find it a little bit hard to get approved for most credit cards and or loans. Now for the second tier is for anyone that has a credit score between 630 and 689. This is anyone who is still new to credit but hasn't had enough time to build it up. Don't worry, because you're on the right track. With this tier, you'll gain access to some of the lower level cards, but you're also starting to break into the higher tier cards. Now the third tier, which is where a little bit of the fun begins, is anywhere between 690 and 719. This is someone who's spent a good amount of time building their credit diligently, and a person who's been paying their card mostly or in full every single month. And of course, without missing a payment. At this point, you're starting to get approved for most of the cards that you apply for. And the fourth and final tier, which is anybody who has a credit score of 720 or higher. At this point, you're the cream of the crop. You've been making sure to diligently pay your bills on time, in full, even multiple times a month. You're also probably a person that spends about 10% of their total credit limit at any given time. And you'll pretty much be approved for any card that you decide to apply for. And they'll practically just throw you the cards at this point. And honestly, pretty much after this point, you don't get any extra benefits for the higher your score is, as the banks mostly just want to see someone with at least a 720 or in some cases 740 credit score to be eligible for most credit cards or even premium interest rates. Also, just because I'm a little bit interested and nosy, leave a comment down below what your credit score is currently. And if one person comments their credit score, I'll reveal mine. Okay, so now that we have the scoring system down, let's go into all the factors that affect your credit score. So I would say there are about 4.5 different factors that determine your credit score, namely, number 1, which is payment history, number 2, which is credit utilization, number 3, which is credit history, and number 4, which is the types of credit that you have, and 4.5, which is how many cards have you applied for recently. But I'll go into why that's a half factor a little bit later in the video. So let's individually break down all of these factors to see where you can improve the most. So the first one being payment history makes up about 30 to 35% of your total credit score, which obviously makes this factor one of the most important. It pretty much just refers to how many positive payments you've made on your credit cards or loans. More specifically, were you ever late or did you ever miss a payment? And I would say for most people, this happens for one of 2 reasons. Either you took on too much debt and you weren't able to pay the minimum payments, or you just completely forgot that a payment was even due. And honestly, the latter almost happened to me on more than a few occasions. To avoid this, just be sure to check your account at least twice a month, so you can know when they're actually due and how much you owe so you can budget accordingly. And remember, one missed payment is not worth a lifetime of bad credit. I should put that on a t-shirt. But of course, it's not a death sentence and it will be forgotten over time. There are also just a bunch of other factors that can improve your credit score, so don't worry. And be sure to stick around for the next few factors, as these are the ones that can really boost your credit score fairly quickly. Speaking of, let's get into the second factor, which is credit utilization. Credit utilization accounts for another 30% of your total credit score. And this just basically means what is the total amount of credit that you are using based on your total credit limit. and it takes into account all of your credit cards. And the more credit that you use, it signals to the banks that you are in need of this money, and that you have a higher likelihood of overextending and taking out too much debt that you might not be able to pay back. Having a low credit utilization just means that you're not in dire need of the money, or that you pay off your card in full fairly often. And for another quick tip, there's some people out there that I see that suggest paying off your card twice monthly to directly raise your credit score. Even though it's not necessarily directly, I'll show you how it helps you indirectly. When the credit bureaus check your utilization, it can be somewhat random. Maybe they check it the first week of the month, maybe the second week, maybe the third week. But if you were to pay off your card twice monthly, you have two different opportunities that the credit bureaus can check your utilization. And when you pay it off more often, you have a higher likelihood that it will show a $0 balance, which of course would be zero utilization, and that would be super good for your credit score. Okay, so moving on, let's go on to number 3, which is credit history. This one is a little bit lower and takes up about 15% of your total credit score. And it's pretty much just seeing how long you've established credit for. Banks just want to see that you've been paying your bills on time for years, not just weeks or months. Especially if you're a person watching this video right now and you're just 18 years old, you have a lot of time on your side. By the time you're 25 years old and you do all the tips I show you in this video, you already have 7 years of good credit history. And unfortunately for this factor, it's not one that you can really force. It's either you've had credit for a long time or not. The only thing you could really do is that if you don't have a credit card already, what are you doing? Go out there and get a credit card already. Sorry, I shouldn't be screaming at you. But if you do already, keep it up. You're doing great. So the fourth factor just has to do with how many types of credit that you have. This one accounts for about 10% of your total credit score. And they just want to see a wide variety of loans, such as student loans, car loans, home loans, and of course the credit card loans. Banks love to see different types of loans as you're able to handle different interest rates, different time intervals, and overall just shows that you've been able to handle a wide variety of debt, which also means that you are not new when it comes to borrowing money. And my advice on this is to take it step by step, don't rush. You're in college and you already have student loan debt. Don't try to go out there and get another loan for a car or even a home, because then it falls back onto the credit utilization category, meaning you're taking out too much debt compared to your total credit limit or your assets. And of course, when the utilization is high, you'll tank your credit score. So I would say be responsible, pay off your loans first, and then you can expand into different loan types. And even take me, up until about a year ago, I only had one form of credit, which was from credit cards. I then had an opportunity to pay cash for my new car, but I decided not to, and to just put a large down payment so it wouldn't be hard to make monthly payments, but I would still have a loan put on my credit file so that the banks could see that I could handle a car loan and credit loan. This way I'm building up a nice diverse portfolio of debt, but it's not putting me in an unsafe financial position. And lastly, that half factor that I talked about a little bit earlier. This one I don't put as a full factor just because, well, I'll just show you. So every time that you apply for a new credit card, you get what's called a hard pull. Hard pulls are just what happens when banks take a deep dive within your credit profile. Which is good because this is the only way they'll be able to access your credit history and approve you, but these hard pulls also slightly lower your credit score for a short period of time. But don't worry, as your credit score should bounce back within a couple of months. However, if you know that pretty soon you're going to need the highest credit score possible for certain loans, like maybe for a car or a house, you might want to hold off on applying for a new credit card, as that will lower your credit score, and maybe you just get unfavorable interest rates on certain loans. So wait until the loan is secured and then you can do whatever you want. And maybe another edge case would be if you're trying to apply for the American Express Platinum card I was talking about. That card usually requires a credit score of 720 or higher, so if you're right on that edge of 720, make sure that you know you're going to get approved for that card before you apply. So now, onto the reason I call it a half factor. Now, while we talked about the reasons that hard pulls affect your credit score if you have a couple of credit cards, I find that when you have at least 5 or more credit cards, your credit score becomes essentially unaffected by each new card opening. For example, I have about 10 credit cards currently, and honestly the last 5 that I applied for completely unaffected my score whatsoever, even though they were all hard pulls on my credit file. And another side note about credit utilization. Remember when we said utilization is based on the total credit you're using based on how much total credit you have. But if you just think about it, the more credit cards you have, the higher your total credit limit, less affected you are by how much credit you're using every single day. For example, if I'm using $100 worth of credit, but my total credit limit is only $100, that's 100% utilization, and that will destroy my credit score. But let's say I have way more credit cards now and I'm using the same $100, but my credit limit is now $1,000. Now I'm only using 10% of my total credit, and that would be therefore positive for my credit score. And also, if you want to see a video on why I have so many credit cards, leave a comment or a like down below and I'll be sure to make that for you. Hit like for the YouTube algorithm if you learned anything so far. Okay, thanks, and back to it. So there you have it. Those are the 4.5 factors that go into your credit score, as well as a few tips for each factor so you can improve your credit score as quickly as possible. Maybe pay down some of your debt and get the utilization down, as well as paying the card completely in full, maybe a couple of times a month. Within 30 days, your credit score should be a decent amount higher. But of course, we always have to remember that this game is not about 30 days, it's about 30 years. So keep doing the right thing and be responsible with your finances and you'll get there in no time. Thank you guys so much for watching. I always like to ask, if you found any value from this video, consider hitting the like and subscribe button, especially if you want to see more videos like this, and it helps the channel out a lot. And leave me a comment down below if you have any questions about this video, or if there are any other topics that you want me to venture into in the future. But with that said, thank you so much for watching, and I'll see you in the next one.